On March 26, 2021, a man named Bill Hwang woke up as one of the richest investors in the world. He was worth $36 billion. 48 hours later, he had nothing, no company, no salvageable bank account, not even the respect of the people who once called him a genius. But the strangest part isn't how much he lost. It's that nobody knew who he was. Bill Hwang was the richest secret investor who ever lived, until a single mistake triggered the largest personal loss in Wall Street history. This is the story of how the son of a Korean pastor built an invisible $36 billion fortune and destroyed it in less time than it takes to watch a movie. Bill Hwang was born in 1964 in South Korea, the son of a Protestant pastor. His family emigrated to the United States when he was 18. His father died shortly after. His mother raised him alone in Las Vegas. Working as a housekeeper, Hwang didn't speak English. He failed classes in college. He worked at McDonald's while studying. Nobody would have bet on him. But something changed when he entered UCLA and discovered finance. Something about markets, the patterns, the mathematical logic, the idea that a single move could change your life, obsessed him. He studied day and night. His classmates remembered him as a quiet young man who always sat in the front row, filled entire notebooks with calculations, and stayed after class asking questions no one else dared to ask. Socially invisible. But in the classroom, he burned. He earned an MBA from Carnegie Mellon, one of the most demanding business schools in America. And in 1996, the moment that changed his life happened. He landed a position at Tiger Management. To understand why this was extraordinary, you have to understand who Julian Robertson was. Robertson was the modern godfather of hedge funds. He had founded Tiger Management in 1980 with $8 million. By the 90s, he was managing over $22 billion. He was considered the most influential investor on Wall Street after Warren Buffett. Robertson had an obsession: finding brilliant young men with pure mathematical instinct and teaching them to trade like him. He called them Tiger Cubs. Some of the most successful hedge funds of the 21st century were founded by former Tiger Cubs. Robertson saw something in Hwang that few others saw: a rare mix of cold mathematics and savage ambition. He gave him access, he gave him capital, and he gave him something even more valuable: his thinking system. How to identify undervalued companies, how to bet enormous amounts without flinching, how to absorb temporary losses to win massively in the end. It was the silent beginning of the most dangerous Tiger Cub ever created. At Tiger Management, Hwang proved to be a natural trader. His specialty: Asian markets, especially Chinese and Korean stocks that most of Wall Street didn't understand. He found undervalued companies and bet enormous amounts of money, bigger than most would dare. It worked. By 2001, he was managing billions of dollars in Asian positions. When Robertson closed Tiger Management in 2000, he gave Hwang seed capital to open his own fund, Tiger Asia Management. It was the most prestigious seal of approval a trader could receive. Hwang had just graduated from cub to adult tiger. For 6 years, everything was rise. Tiger Asia grew to manage over $8 billion. Hwang was considered the absolute king of Asian trading. His annual returns consistently exceeded 30%. He was a machine. But in 2008, his world collapsed for the first time. Hwang was charged by the SEC and Hong Kong regulators with insider trading involving Chinese banks. The specific accusation: he had bought and sold shares of China Construction Bank and Bank of China, using confidential information obtained in private meetings with executives. He paid $44 million in fines. He was banned from trading in Hong Kong for life. Tiger Asia was forced to close and return money to its investors. His official career was over. Most people would have retired. At 49, with hundreds of millions in the bank, Hwang could have bought a mansion on Long Island and disappeared. But he did the opposite. In 2013, he opened Archegos Capital Management, a family office. Here's the legal trick that changed everything. Family offices manage their own money, not outside investor money. That's why they're barely regulated. They don't have to report their positions to the SEC. They don't have to publicly disclose their investments. They can operate in the shadows. For Hwang, banned in Hong Kong and watched by American regulators, it was the perfect hiding place. He started with $200 million of his personal fortune. And then he did something no family office had ever done at that scale. He borrowed money. A lot of money. Hwang used something called total return swaps, complex financial derivatives that let him bet on stocks without technically owning them. The banks bought the stocks for him and transferred the returns to him in exchange for a fee. Stop for a second. Imagine you walk into a casino with $20,000. You convince 5 different casinos to each lend you another $140,000 without telling any of them about the others. Each casino thinks it's the only one giving you credit. Each one assumes the risk is manageable, but together, they've given the same person nearly $1 million of exposure. That's exactly what Hwang did on Wall Street. Except his casinos were the 6 biggest investment banks in the world: Credit Suisse, Nomura, Morgan Stanley, UBS, Goldman Sachs, and Mitsubishi UFJ. Each bank lent him between 5 and 10 times his own capital to bet on the same stocks. And because of the opaque nature of total return swaps, none of them knew how much the other 5 were lending him. By 2021, Bill Hwang controlled positions worth over $160 billion, with only $20 billion of his own money. And nobody knew. Not the SEC, not Wall Street, not even the banks financing him. He was the most exposed man in finance, hiding in plain sight. March 2021, Bill Hwang was worth approximately $36 billion in net terms. If he had published his wealth, he would have been richer than Steve Ballmer, George Soros, or Ray Dalio. He would have been among the 30 richest people on the planet. But Hwang still ran everything from a modest office in Manhattan, with a small team of fewer than 50 people and a normal computer. He wore simple suits bought at department stores. He drove a used Hyundai. He lived in a $3 million house in Tenafly, New Jersey, modest for someone with his fortune. He donated millions to evangelical churches. His wife didn't know how much they truly had. Every morning, Hwang prayed before trading. He called God his investment partner. He said his gains were a blessing for the kingdom. In private interviews with pastors recorded in 2018 and 2019, he confessed that he felt God himself was whispering which stocks to buy. "I'm investing with God watching," he said in an interview with the Manhattan Institute. "He decides what comes in and what goes out of my mind." His main positions concentrated in 6 specific stocks. First, Viacom-CBS, the American media giant betting everything on its new streaming service, Paramount+. Hwang accumulated nearly $20 billion in this stock. Second, Discovery, another media conglomerate in the middle of digital transformation. Third, Tencent Music Entertainment, the Chinese version of Spotify, in full growth. Fourth, Baidu, the dominant search engine in China. Fifth, Vipeshop, a Chinese e-commerce platform. And sixth, GSX Takedo, later renamed Gaotu Tachedu, a Chinese online education company. All 6 had something in common. They were stocks with relatively small floats, meaning Hwang could move the price simply by buying more. When he bought, other investors saw the price rise and bought too, creating a snowball effect. He bet enormous amounts, between $20 and $30 billion in some of these stocks, all concentrated. No diversification, no safety net. Every stock he touched went up. Banks competed to lend him more money because the commissions were enormous, and until that moment, there hadn't been a single problem. Credit Suisse had loaned him $10 billion, Nomura $3 billion, Morgan Stanley more, UBS, Goldman, Mitsubishi, UFJ. Everyone was at the party. Viacom-CBS rose from $12 to $100 in 12 months, largely because Hwang kept buying aggressively. It was a perfect circle. He bought. The stock went up. Banks gave him more credit because his positions were worth more. He bought more. But there's a rule on Wall Street that Hwang deliberately ignored. What rises on artificial demand falls by real gravity. Monday, March 22nd, 2021. Viacom-CBS announces it will issue $3 billion in new shares to fund its streaming service. It's a normal, even rational decision. Many companies do this to finance expansions, but for Hwang, it was a death sentence. Here's why. When a company issues new shares, it dilutes the value of existing ones. The stock fell 9% on Monday, another 23% on Tuesday. By Wednesday, it had lost 50% of its value. Hwang had approximately $20 billion in Viacom-CBS. When the stock falls 50%, that's a nominal loss of $10 billion, more than all his own capital. But remember, he operated with 5 to 10 times leverage. The losses multiplied exponentially. The banks called demanding more collateral. On Wall Street, it's called a margin call. Put up more money or we sell your positions by force to cover the losses. Hwang had no more money. Everything was committed in positions that were collapsing simultaneously. The night of Wednesday, March 24th, 2021, was the strangest night in recent Wall Street history. The 6 main banks that had financed Hwang connected to an emergency call coordinated by Credit Suisse. The time, 7:30 p.m. New York time. Credit Suisse, Nomura, Morgan Stanley, UBS, Goldman Sachs, Mitsubishi, UFJ. Each bank entered the call thinking Hwang was an important but manageable client. Each one assumed the others had smaller exposures or none at all. And then they started talking. The Credit Suisse representative mentioned they had $10 billion exposed. Silence. The Nomura representative admitted $3 billion. More silence. Morgan Stanley, UBS, Goldman, Mitsubishi. One by one, they revealed their numbers. Each bank discovered in that moment that the other 5 were also exposed to the same client, in the same stocks, in positions collapsing at the same time. Combined total, over $50 billion in exposure, concentrated on a single trader. It was the first time in modern financial history that 6 banks discovered simultaneously that they had been deceived by the same person, at the same scale, at the same moment. The executives proposed coordinating the liquidation, selling positions slowly over several days so as not to destroy the stocks and preserve some recoverable value. It was the rational solution. If everyone sold at the same time, prices would collapse and everyone would lose more. Goldman Sachs and Morgan Stanley said yes. They agreed to coordinate. And then in secret did the opposite. First thing Thursday morning, March 25th, before the market officially opened, Goldman Sachs and Morgan Stanley began selling everything. Brutally, blocks of shares worth billions thrown into the market in forced sale operations. By the time the other banks realized what was happening, prices were already in free fall. Viacom CBS lost another 27% just on Friday. Discovery fell 27%. Chinese stocks collapsed. Credit Suisse and Nomura, the last to sell, the most loyal to the original agreement, received pennies on the dollar. Mitsubishi UFJ and UBS were also trapped. Goldman and Morgan Stanley, through their coordinated betrayal, came out almost unscathed. Friday, March 26, 2021. In less than 48 hours, Bill Hwang had lost approximately $20 billion of his personal wealth, the fastest fortune evaporation in documented Wall Street history. But the losses weren't only his. The banks bled too. Credit Suisse, $5.5 billion lost. The largest bank in Switzerland never truly recovered from the blow. 3 years later, in March 2023, Credit Suisse was emergency rescued by UBS to avoid complete bankruptcy. An institution with 167 years of history, founded in 1856, ceased to exist, largely because of its exposure to Archegos. Nomura, $2.9 billion lost. Morgan Stanley, $911 million. UBS, $774 million. Mitsubishi, UFJ, $270 million. Combined total, over $10 billion in bank losses from the decision to lend to a single client operating in the shadows. In April 2022, the FBI arrested Bill Hwang at his New Jersey home at 6 a.m. He was charged with 11 counts: fraud, market manipulation, conspiracy. Prosecutors argued that Hwang had systematically lied to banks about his real exposure, artificially inflating stock prices through coordinated buying, and concealing material information from his financial counterparties. In July 2024, a federal judge sentenced him to 18 years in prison and ordered him to pay over $12 billion in restitution. Hwang is currently 60 years old. If he serves the full sentence, he'll walk free at 78. And the $20 billion he lost, they never existed in real terms. It was leveraged wealth, borrowed money on top of borrowed money. When the chain broke, it all disappeared like smoke. The story of Bill Hwang is not just the story of a fallen trader. It's something deeper. It's the story of how the modern financial system allows a single man, operating with enough opaque leverage, to expose the 6 largest banks in the world to catastrophic losses without any of them realizing until it's too late. It's important to remember that Hwang was not the first to fall this way. In 1998, Long-Term Capital Management, a hedge fund led by 2 Nobel Prize winners in economics, collapsed from similar exposure, nearly taking the global financial system with it. In 2008, Lehman Brothers fell from the same opaque leverage dynamics. In 2021, Archegos. Each time the lesson seems to be the same. And each time the system seems to forget it. The lesson of Bill Hwang. There are 3 rules he broke simultaneously, and any single one would have been enough to destroy him. First, extreme concentration. He bet everything on 5 or 6 stocks. No mathematical genius survives a lack of diversification. Second, opaque leverage. He borrowed from multiple banks without them knowing. When the system found out, they all sold at the same time. Opacity works on the way up. On the way down, it buries you. Third, and most dangerous, he believed he had divine reason. He called God his partner. When someone believes they have a truth superior to the market, they stop listening to warning signs. They stop questioning their decisions. They stop seeing the crack. According to federal prosecutors, Hwang was not a victim of the market. He was a victim of his own absolute certainty. Because in the end, no matter how brilliant you are, how religious you feel, or how many billions you manage, the market always collects, and it never warns you when. Every empire eventually falls. If you choose to witness their stories, subscribe to Rise and Ruin. Next, we follow another empire from glory to dust.